Hi, welcome to the second instalment on money and the economic principles, in which we're going to be looking at the emergence of banking. Now, we're looking at this from the point of view of economics, not from the historical perspective of who formed what bank and what happened to it. Now, remember from the origins of money video, the first one, that money evolves. It's not invented, it evolves through commercial activity. Money does not require a government or a legislation to evolve or form, right? Traders are also keen to cut the costs of exchange, and the market, that is other traders, will always be offering services to facilitate trade, to make it easier for each other. Now, one of the earliest services offered on the market was deposit banking. Now, deposit bankers would hold clients' funds for security purposes, and they would charge a fee for this service. This function still exists today for people preferring to hold their cash on a deposit account or the family valuables in a bank safe. Now, soon traders and bankers realized that actually taking the money out of the bank was costly compared to the traders using tokens, or what we call monetary substitutes, money substitutes in the marketplace instead. Money substitutes included handwritten checks drawn on the trader's account. These would then be used in, say, a single transaction, and the payee, the person that you've just paid the check to, will then take it to her bank, which would in turn present that check at the original trader's account. Money would then pass from the first bank to the second, right, from the drawers to the payees. Now, when such transactions increased, the banks in turn realized that they could cut costs on transporting each trader's money back and forth at the end of the evening by just adding up in the columns and subtracting the amounts owing to each bank and just paying the difference. So rather than a million florins going from one bank to another, then 800,000 moving from bank B to bank A, you just transfer 200,000. Again, bank clearing was an obvious development which helped to reduce transaction and banking costs. And remember that traders are keen to reduce transaction costs in exchange. We're just interested in exchanging goods for goods, goods for services, services for services, etc. So where there's competition between service providers, the bankers, etc., entrepreneurs will try to attract more business their way by a better or cheaper service, by offering ways of facilitating the trade. That's absolutely critical. Now, it wasn't long before banks began issuing notes and token coins alongside checking facilities. Now, it doesn't matter historically whether this was done by a government bank, like a nationalised bank, a Royal Mint, for example, or by the commercial banks. That doesn't matter, right? We're looking at the economic principles here. Now, checks are pieces of paper, obviously, denominated in a particular amount. They were and still are not very tradable, I should say tradable. The payee could be left blank, so it could act as a £500 banknote, say, but a specific amount is rather restricted. So if I write a cheque for £4.99 for you, you're not likely to be able to find many transactions that are worth £4.99 if we leave the payee blank, right? It's going to be written, I'm going to write it to John Smith. So John Smith's got £4.99, he's going to go and present it in his bank for exchange later on through clearance. Now, if it's a 500 banknote, yes, it could circulate a little bit more because there are more things that we could do with £500, including getting change back from it. So therefore, the banks tended to develop notes denominated in different amounts, sort of a £5 note, £10 note, £20 note, £1 note, £half note, whatever, that could then circulate in the marketplace and be presented when the traders wanted to pull out hard money for other purposes. What do we mean by hard money? We mean the gold or silver, particularly, that the banks would be holding on account in the deposits, right, on your deposit account. Now, if you look at modern banknotes, they say that X bank, let's say it's the Bank of England, or it could be the Bank of Dr. Mosley, promises to pay the bearer the sum of £20 on demand, usually. Now, they used to say or imply in gold or silver, so you'd take your bank note to the bank and you would get in exchange some gold or silver in return. Now, you didn't have to, you could keep on circulating the £20 with other traders, etc., but every now and again you might want the hard cash out of the bank. So notes and coins could circulate for a long time before being presented. Now this was a great boon to traders, as it again reduced and still reduces the cost of exchanging goods and services in the marketplace. Now in more recent years, we've seen the development of cash cards that could be used to withdraw funds from machines 24/7, as well as direct debit cards that allow a transaction for specific amounts to be debited electronically. The rise of internet banking also reduces the costs of having to visit banks and to pay bills online. This is fantastic. I live in the middle of the countryside, so I can do a lot of my banking without having to travel 8 miles to my local bank to faff around, for a couple of hours with parking and things like that, and needing the toilet or getting a sandwich. Oh, what a load of faff. I can do that in my own kitchen while I do my banking. Woohoo! Love it. Direct debits and standing orders will also reduce the exchange costs by automating regular payments. I don't have to think about my mortgage going out. Right, in the old days, you'd have to go and put the cash in the bank. There's my mortgage payment, or write a check out. Now it's all automated. Fantastic. Again, remember that traders, doesn't matter what we're exchanging, goods, services, are keen to reduce the costs of trading. That's what a lot of the economics of money is all about. Now, let's just move on to what is the effect on prices, because this is going to be a big issue as we go into other units. At this stage, there is no massive economic issue arising. The value of the monetary substitutes circulating in the market is determined by the physical deposits of hard money held in the banks, because they're equal. If I've got a note saying this is worth £100 worth of silver, literally a weight of silver, I could go and exchange it for the physical quantity of the £100 worth of silver and go and stash it in my shed or whatever, dig a hole at the bottom of the garden sort of thing. But I don't want to do that because of the risk, etc. So I'm quite happy to have that £100 note. But that £100 note is equal to, it's no more, no less than the £100 worth of silver, the weight of silver in the bank. Simple. Now, prices in the market adjust up and down according to the supply and demand and their relationship with the market value of money. The market value of money, whose value is also determined by the demand and supply for monetary commodities, right? So we have a demand for money, we have a supply of money, and it's these which set the value of money in the marketplace, like of anything, set by demand and supply. But it's also the demand and supply of money with respect to the demand and supply of goods and services. So let's have a quick review of this. I'll be doing modules on this later on, but anyway, showing you the diagrams, the traditional diagrams we use in microeconomics. When the supply of gold or silver entering the marketplace and the banks, if that increases, the value of money falls. So that should say when the supply of gold or silver entering the marketplace and the banks increases, the value of money falls, and therefore if the value of money falls, the prices of goods and services rise accordingly. Inflation, right? If the supply of gold or silver falls rather than increases, the price of goods and services will also fall, as now less money is chasing the same amount of goods. Less money is now chasing the same amount of goods. In other words, that pound of silver or that ounce of silver or that gram of silver, whatever the denomination, is now purchasing more than it did before because it's worth more. There's less of it in the marketplace. If there's less of it in the marketplace, it's worth more. Now, what is critical in the review so far is that monetary values are set by the marketplace. They still are, even if we rush to the future, 21st century, the Bank of England, the Federal Reserve Bank, the Bank of Europe, the Bank of Japan, Bank of China, etc., Bank of Australia, they're printing money, etc. The value of that money is still set by the marketplace, not by God, not by nature, not by government, not by committee. It's the marketplace, in other words, demand and supply. Gold's value, for example, if we rush back to hardcore money, gold's value is dependent on its exchange value for jewellery, production purposes, like in iPhones, etc., and its role for money. Now, if the demand for jewellery increased, gold would leave the money markets and thereby have a deflationary effect on prices. Boing, prices will start to fall in the goods and services market because less gold is now chasing the same amount of goods in the marketplace because it's all gone over to jewellery because people want more gold jewellery. It becomes fashionable or something. On the other hand, if demand for gold for use as money increases, we want more money in the marketplace, then gold would leave the jewellery and industrial uses, creating a relative scarcity there, pushing up prices for gold rings, for example, and dowries. And in turn, the influx of gold into the money markets would create an inflationary effect. An inflationary effect because more gold is now chasing the same amount of goods and services than before. The value of an ounce of gold, such as a sovereign, would then fall in terms of what it could buy. Spelt incorrectly there, excuse my typo. I.e. there would be an inflationary effect. Now, what all this means so far, and I want to drill this into you, is that if banks run on 100% reserves, 100% reserves, I mean, why are we talking about this? Because banks today don't run on 100% reserves, they run on 10% or even less. Well, we'll look at that in another module. But if banks run on 100% reserves, the economic effects of deposit banking are generally positive, as such facilities as checking and note issuing for clients, electronic point-of-sale transaction services, and internet banking all act to reduce the costs of actually doing business. And the market is all about doing business, exchanging goods for goods, production for production, whether it's a service, whether it's a good, it doesn't matter. But we want to exchange. Money is just the medium through which we exchange our productivity in return for the things we want. Wow. Now, there is also investment banking. The other kind of banking that emerged quite quickly, again another typo there, notice them, quite quickly in complex trading societies was investment banking. Now some traders need credit to start a business or to expand it. Now others might need temporary funds to help it through a seasonal downturn in demand. This is predictable. In winter, ice cream sales tend to fall, so you might need some funds just to keep paying the staff or preparing new marketing for the spring and summer. Or ski season resorts see a drop in demand, of course, over the summer months, unless you're sitting on a glacier. Now, other traders have surplus funds to lend. This is what the market sniffs out. Entrepreneurs, individuals who have they can sniff out where there's profitable opportunities, will sniff this out and go, hey, there's some guys here in need of funds and there are other guys over here with surplus funds. Duh, let's put them together and earn a bit of commission. Finding people to borrow from or to lend to can be a costly exercise, so the market produces brokers. In other words, entrepreneurs come into the market and act as those intermediaries between borrowers and lenders. These investment brokers, which is a much better term than investment bankers, I much prefer it, investment brokers, because that's what they're doing, enable investment funds to flow from those with surpluses to those who need to borrow. Simple, right? What are the benefits? Untold. But unfortunately, mostly misunderstood by politicians and some economists, unfortunately, who have a go at investment bankers. No, they're investment brokers. They're acting as an intermediary. Investing is the lifeblood of the market economy. Where investment flourishes, economies enjoy economic growth. So investment brokering, bringing people together who've got surplus funds and putting them together with people who need funds, and vice versa, is the lifeblood of a complicated open market economy. Wow. And this is why, where investment flourishes, economies enjoy economic growth. Where investment is taxed to the hilt or is made difficult by regulations and complex banking laws, or refusal of the government to allow banking to flourish or investment to flourish, or it's taxed for its profits, funnily enough, those economies stop growing, right? All things being equal. Now, in the next tutorial, we'll be looking at what can go wrong with banking and why. And oh boy, things can go wrong with banking, and they do. And this is what causes some of the big issues we see in modern economies. Right, thanks for listening, guys. I'll see you in the next tutorial. And don't forget to check us out, the Economic Circle magazine, which is available on Apple Newsstand and Google Play. It's a very reasonable price. We do monthly issues, mainly produced by myself, bringing in other contributors accordingly. And look forward to seeing you in them. All right, thanks very much. See you in the next tutorial. Bye.